Dear investors, Prasenjit Paul here. If you are an existing investor or if you are planning to invest with us or planning to opt for our advisory service, then this video is a must watch for you. Because in this video, I'll show how we initiate an idea, how we refine stocks, then shortlist stocks, how we do fundamental analysis, how we come to the target price, and finally, how we invest or how we recommend a stock. So for existing investors or for any prospective investors who are looking to opt for our service, this video will offer you a clear guidance whether you can rely or how much you can rely on our research capability and on our service. So first of all, a general basic disclaimer: this is obviously not any buy, sell or hold recommendation. Don't consider this video as an stock tips. The purpose of this video is to show our investment philosophy, how we select stocks with a real life example. And as usual, like, you can read the disclaimer full, or otherwise myself, Prasenjit Paul, I am the director and the key beneficiary of the company Paul Asset Consultant Private Limited, which is a SEBI registered research analyst firm which offers research service, stock recommendation service, and at the same time Paul Asset is the investment manager and sponsor of category 3 alternative investment fund 129 wealth fund, which is also registered with SEBI. So under this 129 wealth fund, under AIF arrangement, we collect funds, we pool funds from high net worth individuals, and then it acts as an investment vehicle. So first of all, what's our goal? The goal of this video is to demonstrate how we conduct equity research. Now I'll show from the idea generation to refinement, then to shortlist multiple companies, and from those shortlisted companies how we are arriving at a well informed investment decision. And we'll discuss about a lot of stocks. Maybe we'll name maybe around 10-12 stocks in this video, but remember, none of the stocks discussed in this video are stock recommendation. We strictly, maybe while you are watching this video, maybe after 6 months, 1 year or whatever, in fact the date is visible in my screen, if anyone invest on any particular point of time after watching that video, we are not liable. In fact, we strictly don't answer any of your queries if you treat this video as an free stock tips. So don't consider this is not a free stock tips. The purpose is not to free stock tips, rather to show how we do the research. So this is, apart from general disclaimer, this is the second time I'm communicating the same. Don't consider this as a free stock tips, otherwise you yourself get trapped. Now the key theme that we are working since 2023 or 24, we all know that AI is the theme of decade, artificial intelligence. Now AI uses across the workflow must increase. There's no doubt on that, be it on the IT sector, be it on even medical segment, legal segment, or even in our own equity research. We also use a lot of AI tools, to fast track our research. So AI will be a hot theme. AI users must increase, but there's a big problem with AI artificial intelligence. It means, like, to run all those chat GPT, Gemini, you need data center, you need semiconductor, very advanced semiconductor, advanced electronic system. So in Indian market, if you look at the frontline AI stocks name in the Indian market, like Anantraj, who built data center, Kens Technology, Techno Electric, Dixon is like EMS player, it's not directly related. So you'll find a surprising fact that in 2025 itself, all these stocks corrected by 40, 50, 60% despite their huge business growth. Like, if I am looking at the stocks, like let's say Kens Technology, now this company, this is not a poor quality stock, this is not a bad stock, but look at the stock price. So from 7,500, within just 2 months the price crashed to 3,600. Same with you call it Anantraj. Now these are frontline names, these are big companies. I am not talking about small companies, those corrected by 60-70% in 2025. So Anantraj also, it was around 900 last year in January 2025. Today, January 26, it's around 566. So again, the date is visible, so I am doing this screen recording with a full screen recording for some purpose. Be it Anantraj, or if you call this Techno Electric, that's also a very hot stock. They develop multiple data centers, they have contracts. So now look at the stock price. Now the key theme that I wish to share you, that while frontline names are expensive, we look for proxies. We never invest, even back in 2024 or in 2025. We never opted to invest in Ken's Technology or Anant Raj, no matter how attractive the story is. The simple point, our investment philosophy, one of our points that we follow, no matter how attractive the story is, investing in a stock at 190 or 100 plus PE always carries risk. Today, which is a stock at 100 PE, may continue its uptrend for some time, but there's always risk of getting stuck near peak. Obviously, you can see that even at a stock at PE reached 130 or 150 or whatever, the stock price may still continue its uptrend, but you never know when the peak is. I mean, there's a high possibility you may get stuck near peak level. So that's why we opt for proxy investing or second line beneficiary. So how now we kept on thinking a much latter part of, over the last 3 4 months, what are the themes that can, AI can benefit. Now we figured out that adoption of AI is reducing manpower cost. So all service based companies, those are some specialized services company, can fetch higher revenue per employee that can increase their margin and profitability. If you follow the news, a lot of IT firms, they are reducing their manpower. So what it simply means, it simply means artificial intelligence, AI, all this, AI and LM model and all, they will simply reduce the manpower. Now among the service companies, there are two type of companies. One is generic service provider. Now there is a lot of debate going on, like whether AI can hurt a lot of companies or AI can benefit. So I divided companies in two part: generic service provider. For this, there is a high risk of getting replaced by AI itself. Like if you just consider the example of companies like logo designer or graphic designing firm. Now obviously, if a human being design a logo or graphics, whatever the time he or she may take and whatever the quality they offer, today AI model can offer much better quality at much lesser time. So there's a risk. So if there is a small company who is totally dependent on logo designing, graphic designing, website designing, for them there is a high risk that AI can replace their business itself. But if there are some specialized service provider, now for a very simple example, let's consider a law firm, or a research firm like us, or if I tell about the law firm example, it will be much easier. Now for a law firm, AI will reduce the time of drafting long and complex documents, in all the court case or while you file a suit. So this is a huge long drafting for any court materials and all. Now with the help of AI, so the time required to draft all those will reduce. But AI can't replace the brain of a skilled lawyer. Similarly, AI can't replace a doctor. But what AI can do, actually it's happening in US, what AI can do, AI can make the task of doctor easy. So whatever the time doctor is spending on non-core activities, that AI will get replaced. Same in our research field, in equity research, AI can't replace our brain, but what AI will do, AI can reduce the time. So earlier it took 1 hour, 2 hour, or 3 hours, maybe a whole day to read few annual reports, few con call. Nowadays, within just 1 hour, we can read annual report, or we can extract the all important points of annual report from conference call, from management interview within just 1 or 2 hours. So the point is, our focus on the specialized service provider. For that, what we did, we opted to figure out companies where employee expense is more than 40% of the total expense. So the thesis is like this. Okay, so today a company is, say for example, today a total expense of a particular company is 100 rupees. Now out of that 100 rupees, 50 to 60 rupees, their expense is on employees. Now as the employee number of employee will reduce, or the same employee can do more specialized work, so simply what will happen, so for obviously it is only applicable for some specialized firm, so the number of employees will reduce, or the employee expense will reduce, which will help the margin expansion of the company. And margin expansion means the profitability will jump. So my target was to figure out companies those are not replaced by the AI, but companies those can utilize AI to reduce their expenses. So we searched on the screener with a simple screening tool of the employee expense. If you follow this one, employee cost by sales more than 40%. So this is a custom made query. So based on that, afterwards I just, okay, here also you can check like how many companies. So if I just do this, like employee cost by sales more than 40%. So around 459 companies, there's around 450. Now I opted for some refinement. So once I opted for some refinement, then it came 123 companies. The basic simple refinement, I just ensured return on capital employed more than 8% and market capitalization of more than 50%. So now we got 123 companies. Now from those 123 companies, I did a quick scan. So I read about the business, whether there are any moat or not. So just a quick overview of those companies, again with the help of AI. And first of all, I excluded those large IT names, TCS, Infosys, Wipro, and all, because they are a big firm. And the problem with such big firm is like that. A lot of tasks today, TCS, Infosys, Wipro, they are doing is the generic tasks. Obviously, they are doing a lot of specialized work as well. So those companies, the large cap IT names, are not sitting in our investment thesis. So from those 123 companies, from these 123 companies, I shortlisted these 11 companies. Actually there are 12, 13. So right now we can recall this. Now based on what parameters we shortlisted, so all the companies are doing some sort of specialized job. There must be some sort of customer stickiness. AI can't replace those jobs. So whatever these companies are doing, it's not easy for AI to replace those jobs, but AI can help those companies to generate more revenue from the similar number of employees. So that's how we get this list. Again, warning, don't consider this list as a free stock tips or whatever. If you invest in any companies from this list, the risk is full yours. You are yourself that there are high chances that you yourself might get trapped. So from these 11 companies, initially we like this company, Explio Solutions. So if you look at this Explio Solutions, why I liked that company? First of all, it had very strong fundamentals, strong free cash flow. The stock was available at around 15 PE. Obviously, all this research I did on December 2025. Now it's January 14 January today, as you can see in my this is the date, time, as you can also see. So based on December 2025, Explio Solutions said this available at very reasonable PE. The another interesting point we figured out, the German parent, the company, this again, if I just Explio, so it didn't take much time, from the screener itself. Once you go through the shareholding pattern, so in shareholding pattern itself, you can see the name of this promoter, Explio Germany GM. So this is a very positive, because for a microcap stocks or a market cap of only 1,500 crore, stock PE at only around 14, German parent holding means I can rest assured that okay, some sort of green signal or corporate governance and some sort of global order flow visibility. But we didn't proceed because of the higher dependency on EU clients. Basically, this company, as the parent is a German or European company, so a lot of revenue they derives from European OEM players. Now I am very much negative on Europe after this Russia Ukraine war. Even if the war stops today, then also the future of both Europe and Russia will remain bleak, because the cheap oil that Europe was getting from Russia, that's gone forever. And if you follow some news, and or if you stay in Europe, you might follow over the last 2 3 years inflation increased a lot. A lot of factories are shifting their base from Germany. Germany was the industrial capital of Europe, but from Germany, lot of factories, they are already either shifted to US or shifted to China, or again, Europe China relation was not that good, few parts shifted to India or to Southeast Asia. So simply putting, a lot of factories in the EU are getting closed, or they reduced their manufacturing output simply because their energy cost or oil or gas price increased a bit. And even if today itself Russia Ukraine war stops, then also I think the future of Europe is not that good. And that's how we need to employ all these things in our research. Russia Ukraine war, okay, so that's already in our mind. Now we are just incorporating while we are shortlisting this company. So that is the only reason, like this Europe Russia Ukraine war, that we discarded Explio Solutions. I didn't dig deeper. Just spend 1 and 2 hours, and after 1 2 hours, okay, so let's move forward for the next name. So now afterwards we checked this Explio, Onward, Sustain, ASM Technology, Axis Kids all together, because all these business 1 2 3 4 5, you will find all these business have some sort of similarities. And out of these 5 companies, once I researched all those 5 companies, I figured out Onward Technology as a standout opportunity. Now just visualize the time and effort needed to figure out a single investment or this stock. So today you can see only one stock recommendation, but you never realize behind that single stock recommendation we might have scanned those 120 companies, then refined 10-50 companies, and then from 10 to 15 or 10-12 companies, maybe one or two stands out, and those one or two either we recommend or we invested in our AIF or we invest in our personal portfolio. And lot of times it happens that by the time we complete the research, stock price moves up, making it again a missed opportunity. So the process why I just shared all this, just you need to visualize or you need to realize the kind of effort, because you can only see only one stock recommendation or 10 stock recommendation over 1 year, but you never realize the huge amount of effort that myself and obviously my team, whatever I have mentioned, it's not possible for a single person. A team is required for all sort of things. So obviously without my team, I also, a single person, can't do all sort of things. So just realize the time, effort, the dedication required to shortlist even a single investment. And that's also, there's no guarantee whether that investment will work or not. Many a times happen, by the time we complete everything, some sort of negatives pops out, and then we completely discard the analysis. So now as we shortlisted Onward Technology from those 5 stocks, what's the business of Onward Technologies? In simple terms, they are the extended R&D lab for global manufacturers specializing in digital and engineering service. So let's say these global OEM companies like Mercedes-Benz, Volkswagen, or maybe these industrial giants like Caterpillar. So let's say Mercedes is planning to design, or they are working on some new gear technology or something, some sort of new. So they outsource some part of their research to these companies, to these Indian companies. The business is similar, like L&T Technologies, or maybe you can consider Tata Technologies. But obviously L&T Technologies, Tata Technologies, they are much more diversified and much more bigger player. Onward Technology is a very small company. So the first question that stuck on my mind, okay, can AI replace or help the business? So whenever we dig deeper, all these companies related to the AI theme or related to the service industry, so the first question that stuck on my mind, okay, so this is the business, whether AI can replace the business, as I mentioned in the very beginning, like a logo maker or a graphic designer. So for them, a generic business, it can be easily replaced by AI. So my theory is AI can't replace such specialized research and design based job. Rather, AI will help to increase the productivity. Now this theory is actually is also proved with the fact, while we did digger for this Onward Technology, what we realized that over the last 5 years, revenue of this particular company almost doubled, but total employees remains around 2500, 2600. You can also check all the annual report of the last 4 5 years conference call, you will find this data. Okay, so let's put Onward Technology. So the jump that you can see, the revenue jump that you can see from this level, like from 240, we can say 240 level to kind of 500, almost double. But the total number of employees actually remain similar. So here I guess I have, okay, yes, so this is, I will come into this sheet later on. So here you can see we have also plotted the number of employees. So during FY22, the total number of employees was 2641. Right now this is around 2500. Anyways, I'll come to this sheet later. So this is also what kind of work we do in the background. This is the sheet. So fine. Now next step after the business, now we try to figure out for any stock whether there is any business moat or competitive advantage or not. To understand that, first we checked the fact, okay, so whether these OEM companies, big companies, Mercedes Benz, then Caterpillar, then all these OEM, Volkswagen, BMW, so do they continue to outsource? Yes, obviously. Why a company outsource? Because if the company hired in-house engineers to all those, then their fixed cost will increase. Now a lot of research project may be a 6 month duration, 1 year duration. So after 1 year duration, if they wish to continue those employees, their fixed cost will increase. So that's why they outsource, so that they need to hire fixed employee. Their, I mean, expenses didn't jump a lot, rather through the third party, they do the job. And obviously India offers the cheapest resource, manpower, compared to the US and EU. The same research job, the salary of a US employee or European employee, you can understand, if you compare to the Indian salary, that's multifold higher. So that's the basic theme of outsourcing. Why all these companies, all the this entire IT industry flourished over the last 20-30 years, only because of the fact that in US or in EU, manpower is very costly. In India is very cheap. Now you might heard about this GCC boom. What is this GCC? That is the Global Capability Center. Lot of big companies like Mercedes, they already have a research center in India. BMW, I'm not sure, BMW, Volkswagen, all these companies, all the global industrial giant, they are opening, or they already opened a global capability center in India. And the companies, those have the existing center, they are increasing. Like as you can see, the Google, Microsoft, all these companies have office in India. So instead of outsourcing to some third party, so they themselves are also setting up their research center. Now this is a positive and negative both. Why? First positive is huge volume jump. So all the works from US, EU, those works are coming to India. And if the core research job comes to India, automatically incremental ancillary works will increase, and that will help players like Onward Technology. But the negative is brain drain and wage inflation. It means, let's say Onward Technology, they are doing a project of Mercedes. So now what the salary they are offering to the employee, obviously Mercedes Benz themselves offering much higher salary compared to that. Now obviously for any graduate or for any Indian individual, if they say, okay, I am working at Mercedes Benz research center, it sounds much better. It sounds, I mean, it looks better. It's the aspiration. Okay, I am working at Mercedes, I am working at Google, I am working at Microsoft. Instead of saying, okay, I am working at Onward Technology, which is doing a project of Mercedes, or like I am working on TCS, which is doing a project of Microsoft. So this is the very simple rationale, or this is a very simple thing, that why there are attrition in the IT industry. But overall, GCC will increase the volume of work without the attractive margin. So what all these OEM players will do, be it Mercedes, Caterpillar and all, they'll keep the core jobs or the IP related, those are confidential job with themselves, but they will continue to outsource the ancillary job. So GCC boom, that's positive, negative both. Overall, what we understood, that Onward Technologies has some sort of medium kind of mode. So there is a customer stickiness. Why customer stickiness? Like a certain company, if there is some a project, like, okay, let's redesign my gear, or let's redesign my, what you can say, anything. So let's do all this designing stuff and all. So once a company, once these players receive such kind of project, so it's impossible for the OEM players to switch another vendor, because switching means a lot of hassles. So there's customer stickiness, there's a high switching cost, and that's why there's a long standing relationship with OEM. Onward Technologies, L&T and Technologies, Tata ELXI, or you say Tata Technologies, you will find all these companies mentioned, they have a long standing relationship of 10, 15, 20 years of global OEM partners. This is very natural in this kind of business. Finally, GCC will increase the work volume but may reduce margin. So overall, I find this Onward Technology, the business with medium mode. Now the next big puzzle. So what I figured out while doing the research, I figured out, okay, the business with moat, the long standing customers offer some sort of revenue visibility. Most of their orders, recurring order, multi-year order, so revenue visibility is there. Very strong fundamental, almost zero debt. Here you can find the long term borrowing, short term borrowing is zero. It's just the lease liability. Lease liability is simply like the rental payment they are doing. Otherwise the company is a debt free company. Debt free company, they are generating high and good amount of cash flow year after year. Return ratios are good, everything is fine. Even promoter increased the stake across 2025. So again, just an overlook of this promoter holding, you can see from this 37.86% in March, in June they increased their stake. So even after everything, why the stock price is not responding? How come such business available at around 15-16 PE, while I initially initiated the research back in December, the stock was available at 15 PE. Even if you look at the price chart, this is the price chart, you'll find since 2024, not only 24, since 2023, the stock price is on a downtrend. So this is not matching, I mean, whatever the thesis, whatever we understand, this is not matching with the stock price. So this is why we always say this is the biggest puzzle. If solved properly, either we can unlock future multi-bagger or otherwise we can get trapped. Now what normally happens, if the stock price is like this, despite all the positive, either something is there that we are missing, we are still not able to find out. If we invest, maybe the stock price might remain in similar range, or might fall further over a longer period of time, or it may be a case of due to the overall market, the price is not responding. So we need to figure out exactly what is the case. So for doing that, this is again, I mentioned, one of the most tough tasks in equity research and a very time consuming task. We need to first of all check the corporate governance. A simple search with the term like fraud, scam, like if you search with the term like Onward Technologies fraud or Onward Technologies scam in normal Google search, let's see what kind of results are coming. If nothing such come, okay, so this is the very easiest way. We'll go for the next step. Let's check for the promoter reputation. Who are the promoters? What's their background? Why they are earlier associated with? So promoter, after promoter reputation, we need to check whether there are any one time income or one-off income that is boosting EPS. It might happen in many companies that the PE that you can see, like let's say today it's 17 PE, while we research it was 15. So it might happen this 17 is not a actual PE. There may be some, one-off item. Then we need to check the balance sheet issues, whether there is any bad debt or any huge receivables, like there are pending payment from customers, but those payment the company may not able to recover. Then we need to check the market perception. What are the similar business? What kind of P similar business are comparing? We need to check the sector outlook. Okay, what's the outlook of overall sector in few sectors, like let's say if it is some metal segment, or let's say some oil and gas segment. So there are certain type of companies, those always command low PE. So you need to check on those market perception, similar business, to conclude whether this 17, 15, 17 is a low. Because if it is a oil and gas company, even this 15, 17 is not a low, maybe that's a new normal. But if the company has really some sort of moat, then this is a very low PE. Obviously then management guidance, and also all this is again a huge time consuming process. So now let's see one by one how much we can cover in this presentation. So first thing, for any service based company, promoters. Promoter for a small cap service based company, management plays a huge role. So as you can know, for a service based company, this is not a manufacturing company that okay, you have a factory, so factory is running well or not. This is a people's company. I mean, people, all the brains, those who are behind the business, their decision will make or break the business. So here I was positively surprised. Why? The chairman of this company, Harish Mehta, he is industry legend. He was the co-founder and first chairman of NASCOM. He also had written a book. I forget the name of that book. So basically, he was the colleague of all those, Infosys co-founders. He was in the Indian market. He witnessed the Indian IT boom, and lot of friends are. I mean, he has a circle with lot of friends of those Infosys co-founders, HCL Tech, Wipro guys, and all. So he is a very reputed person in the industry, Harish Mehta. So no doubt on it. You can search the name in Google, you will find his book. Even persons like Nandan Nilekani and all, they recommended this guy, Harish Mehta. He may not be a celebrated person like all other IT names, Nandan Nilekani or Infosys founder Narayana Murthy and all, but he is an equally industry legend. And another interesting point, his son Jigar Mehta, who is a second generation, he entered into the business. So on 2016 he first appointed, and he is a Boston University graduate. He did certification from Harvard Business School. This Harvard Business School certification he did over 2023 to 2025. I just searched his LinkedIn profile and checked all these details. So he is the guy who transformed the company from staffing to engineering. Today, Onward Technology has all sort of moat, but from 90s to 2010 the company didn't grow that much, because they were not able to compete with the likes of Infosys, TCS. So then this second generation Jigar Mehta thought, okay, so I don't want to remain a generic player, rather I want to focus on something specialized. And that's how he transformed the business. So earlier, like back in 2010, the business, serving Indian clients. As on today, they are serving all the big large OEMs. So I was positively surprised. I personally like the combination, like experienced, reputed first generation and aggressive second generation combination very much. So this promoter reputation, corporate governance issues gone, everything is gone. There is no such one off income, no such balance sheet issue. Market perception, as I mentioned, similar business. What are the similar businesses? LTTS. So this L&T technology service. So if you follow these LTTS, they are commanding PE like 35. So these are also very well known stocks. Then Tata ELXI, Persistence, then so these it's not like that, there are some issues with the sector, nothing like that. So still the puzzle remains. Even after spending so much time, we figured out only positives, but I need to figure out the negative, because it's not possible for any stock price to went from this 670 to in December 23 to like this over the last 3 years. This is not possible. Something is there that I must need to figure out. Unless we can figure out something, the research will remain incomplete. Okay, so what's that? So again we dig deeper, and then finally we found ace. So this is basically the screenshot. Actually we have our back end just research. Basically this is the websites anyways. Here the screenshot from that website. So I checked all the management conference call from May 2023 to October 2025. So here is the all the conference call you can see. So since 23 to 25, over the last 3 years, we have checked all the conference call. So there I found what's exactly happening. So what the company did actually in the entire 23, the company shared the aspiration of $100 million revenue company, which is around 800 900 crore company by FY26 with mid-teens margin. Now whatever the guidance they have shared across 23, that miserably failed. Then I realized why. If you look at the stock price, you will find in 23 itself the stock price almost doubled. So as you can see, this double. So this is the result of all those stall promise that okay, we are working on to become 800 900 crore company. So across 23 they guided the same. Then even 24 itself they mentioned the same, but they miserably failed. You can just pause the video, you can read this how I summarized the write up. So the simple point is across 23 24 they guided the moon, but numbers are not matching. Finally, in October 24, I noticed the change in the commentary. So in October 24, they realized the muted scenario, and in October 25 onwards, they are not guiding those 800 900 crore revenue numbers. In May 2025, finally they are in a position to under promise and over deliver, which reflected in actually Q2 FY26. So this is the quarter July 2025 where there is a visible turnaround. Whatever they are guiding since 23 mid-teen margin with 800 900 crore revenue part still they didn't achieved. As you can see, margin, if you follow, they since this time May June 23 they were guiding mid-teens, mean 14 15% kind of margin. So finally in June 25 result and in September 25 they are approaching. So after all these quarters, finally this is the result that they are targeting since 23. Now I will digger. So why they failed over those years and why finally right now it's happening. First of all is obviously the Trump issue. Since after Donald Trump became president of US, a lot of uncertainties. Lot of global companies, they paused their investment because they don't know which way the tariff is going, what kind of thing will happen or not. Now by the end of 2025, so all of these giants, now they got the clarity and now they are increasing investment on US. So as you know, the Trump is focusing on made in America, make America great again. So now all these companies are started investing on US factories, and that's why again all the research and outsourcing jobs are again on the demand. So if I summarize that puzzle, the reading behind the numbers, so management had lofty projections since early 23 and thus the stock price doubled in 23. However, from the second half of 23 till March 25, there's a huge disappointment in margin and also disappointment in growth. So if you follow the growth as well, so here, so this entire period the growth nosedived. Due to this, the stock price was languishing. Finally, in H1 FY26, there's a huge improvement and visible numbers matching management projection. But I think market is not ready to believe or waiting for the confirmation whether those are one-off or not. So whatever the margin increase, this 13%, 14% with the growth, so market is simply looking for confirmation. It might happen, okay, so these two quarters, June and September, these are one off quarter, and again from December quarter, then again from March quarter, then again the growth dip to the single digit, margin to the single digit. There's a possibility. And also you need to understand the fact, in the second half of 2025, the overall market, Indian broader market, is remains very weak. So these are the likely two combination that the stock price is still not reacting. In fact, as I checked all those con calls, so what I figured out, so the company conduct around 4 con calls in a year, and hardly you'll read the con call, hardly 5 or 6 analysts asked question. So October 2025 con call 2 had only 5 or 6 unique participants asking question. Highest participants were during July 23, around 14, so which coincides with the lofty guidance. So during July 23, a lot of participants, lot of investors were interested. Stock price jumped a lot, and then while these things are not matching in number, so then the price kept on falling across 24, 25, and then finally it came to the December 25 period. And if you just look at the historical PE ratio, you will find over the last 3 years, this PE ratio, this December PE, that the 15 that I while I check the stock, this is the lowest since 2020. Okay, so now I'm get a clear idea why the stock price is not reacting, and what it needs to be do. So simply putting, if the market says, okay, the company is consistently offering this mid-teen growth and mid-teen margin, this December quarter result and this March quarter result, if the company can report similar numbers, similar growth and similar margin, then I am sure that the market will reward, or the PE might re-rate. So what are the growth triggers? Once we resolve the puzzle, okay, why the stock price was not reacting till then and why it might react, so now we figured out what are the growth triggers from now onwards. So first of all, high value service shift. So this is they are already, I mean, it's already happening in FY26. They are moving up the value chain from commoditized mechanical design. Like, let's say earlier they were doing mechanical design of some wings or some drivetrain parts, but now they are moving on high value digital and embedded engineering, like be it in tractor, in autos, and all industrial equipment. Everywhere companies are doing this AI thing. Even in the car, if you follow, a lot of softwares are there in the car. So now they are moving up to the value chain. America first tailwind that I have already discussed, Trump push on US manufacturing forces clients like John Deere, Caterpillar, to increase R&D spend. Management mentioned in their con call that they are witnessing never before seen demand from the US. Infrastructure expansion across 2025, what they did, they spent around 12 to 18 crores to open sales office in London, Munich, foreign office, because they wish to place closer to the customer. And in India, they increased their office in Pune, and they also increased their office in Chennai. So aggressive capex in FY25, this kind of capex are always front loaded. So they already invested in office, they already invested in manpower to reap the benefits over the next 2-3 years. What are the margin expansion triggers? Obviously, the first very simple thing is operating leverage. In the last 4-5 years, the revenue surged since 2020, but the headcount remains stable. So it means now in 2025, they had already invested in office expansion and all. So going forward, once the sales growth comes, then obviously the margin will increase. So same thesis, end of the capex cycle. And finally, the internal automation. Management also mentioned the same. What is our initial investment thesis? That the early adoption of AI and in non-billable functions, like in the non-core activities, this is a permanent structural change, and that will help margin by reducing the operational cost. Finally, they are also doing this client mining, trimming the tail. What is this? So the company is moving towards quality over quantity. So earlier they had around 70-80 clients. So now the company mentioned that, okay, from 70-80 we need to reduce to 50-60 to maximize wallet share, to generate more revenue from a single client, because it's easier to have higher revenue from a single client. Obviously it can lead to client concentration, but as I have mentioned, so this kind of business has some sort of customer stickiness. It's not that today you are winning a client and then you are entering into 3-4-5 years project. It's not today you are entering with a contract and then within 6 months the client just change their vendor. That's why the cutting the tail or the client mining, this is a brilliant strategy which can help in increasing the margin. Now, what are the key risks? First risk is obviously the cyclic nature of the end user, but I don't consider as a risk. This is just to mention. So obviously the company is exposed to some bit of old economy like tractor, trucks, industrial equipment. Now recession is in US manufacturing can directly impact the R&D budgets of those big OEMs, but those big OEMs are huge compared to the only 400 500 crore revenue of Onward technology. So that I don't consider as a risk. The biggest, these are the two big risks. First risk is obviously slowing down the growth. Simply, if the growth slows down to single digit after this office expansion and manpower hiring, then automatically higher depreciation and fixed cost will increase, eat their margin. So then it will result in the PE de-rating. And finally, in August 25 or somewhere, not August or maybe in September, we noticed this litigation. So around 11 CR, this is an approximate figure, cash frozen by the US, some sort of salary or wage dispute, but it is again, it is around the 10% of the liquid fund. So even if the court case goes against the company, then also we can expect some one-time knee-jerk reaction. Maybe in particular quarter the result might remain bad, or the company might enter into loss in any particular quarter. Even if it is not lost, the profit might fall drastically, but beyond one quarter, this is not a risk which can sustain quarter after quarter. So this is not a structural risk. This may be an one-time risk. Even if this one-time risk plays out but all the positives remains, then also during such huge correction, that can be a good entry opportunity for investors. Now if I summarize the future or how we do the research, so management guidance, earlier they were guiding 800 900 crore revenue, now they are guiding, or now they are very much optimistic. Latest in October November con call, they are very much optimistic to maintain that mid-teen growth with mid-teen margin. So growth of around 14 15 16 17 or 18% with the margin of around 14 to 15%. Now we projected, so here is the, so this is how we do analysis. So again, this is our back-end analysis. So this sheet is just to understand or just to visualize the kind of effort we put. So this is the, as you can see, this is employee expense divided by revenue. So we simply divided this number. So the company earlier, they had around 77% of their expenses, or 70% of their revenue went into the manpower expense to salaries and all. Obviously, if you follow, this number is reducing, and in the quarterly figure also you will find employee expense is reducing a lot. So from 77 76 75% to now only around 70%. So this is the exact theme. As this is happening, so we can say that okay, so AI is playing out, automation and all is playing out. So here what we did, we projected first of all two type of projection: this mid-teen growth, 15% 17% kind of growth, and then we projected the margin. Based on that, this 14% 15%, this kind of margin came. This is based on the management guidance, and from there, this is our EPS, this is our estimated EPS. Fine. And based on that, here is the P, what kind of stock price we are expecting. Obviously, I don't comment on the stock price expectation. So this is just to showcase how actually we do the research. Along with that, I have considered one worst case scenario for FY27. So worst case scenario is, instead of this 14, 15 or 17, 18% growth, the company falls back again to 8, 9% of growth, which they witnessed in FY24 and 25. So if that happens, this then maybe the company might end with only 600 odd crore revenue by FY27. Then if that happens, then the margin will also fall. So here with this kind of growth, while the margin may improve, margin might expand, with this the margin will fall, that margin will also fall. So we got an EPS based on that number. So this is my best case scenario EPS, this is my worst case scenario EPS. Fine. Now the most important or the tough job is to what kind of PE we can assign to derive our price target. So for that, peer analysis is very important. Peer means all the similar players. So while we did the peer analysis, again, this is a direct screenshot from that website where we do internal research and all. So this is, you can again pause the video and to read this entire thing. So this is all the peers. I have mentioned MC means market capitalization, margin, what they exactly do, which is the closer peer, which is I mentioned second closer, loose peer. Then LTTS, this is the L&T Technology Service, KPIT Tech, Tata Technologies. They are similar business, but they are diversified giant. So you can just pause the video and read everything. So once you read everything, so conclusion is in-depth peer analysis suggested so all those similar business comments EBITDA margin of 15, 16, 18%. So from that I can conclude whatever the management was projecting mid-teen margin, it's feasible. It's not something they are again commenting something moon, because similar players in the same segment, if they are earning this 16, 17% margin, then Onward Technology can also do. And as I mentioned, there are two future scenarios. So over the next 2 to 3 years, 15 to 18% CAGR growth on top line with mid-teen margin. If this happens, then the current PE, like currently the stock is around at 16, 17 PE, this should re-rate to 20, 25 or 30 kind of level. But if the growth falls below 10%, then mid-teen margin is not possible, then PE should remain around 14, 15, 16 range. So these are the two scenario, best case and worst case, and based on that we made some investment decision. So how we made an investment decision? Okay, so again I don't provide any price target, but just to clarify the concept. So best case scenario, over the next 2 to 3 years I can see more than 2x return, but the worst case scenario I can see around 20 to 25% price fall from the present level. Presently I mean on December, while we invested or initiated the research, the stock price was around 290, 270, 280, 290. Today it is around 312, but it was this period. Yes, this is the December month that we did the research and completed most of our investment. So how we invested? So first of all, in my personal portfolio, so I had already invested 80 to 90% much before December quarter result, while the price is suppressed. This is the highest risks and highest return potential if the thesis clicks. Why? Because December 25 quarter is the weakest quarter of the company's history, because in December, you all know, maybe this Europe and EU giants, they went to the holiday. So December is a holiday month for US. So that's why all the companies, those are dependent on US. So December quarter is the weakest quarter. So even in this December quarter, if the company can maintain this mid-teen margin, whatever the margin, operating profit margin, the company maintained this 2 quarter, this around 14 12 to they improve, you can see the improvement. So it improved till 14%. So in December quarter, if 13-14% kind of margin is maintained with this September quarter, revenue increase was around 13%. If 14-15% kind of growth and this kind of margin, if in December it maintains, then it proves okay, my investment rationale is validating. But if not, then again price might correct. So that's why this is the highest risk and highest return potential investment, because in my personal portfolio I am absolutely fine even if the price corrects by 30, 40, 50%, because nobody will question me. It won't impact my personal finance. But I can't do same way in AIF and in advisory service. In AIF, what I did, obviously it's a more, I mean, it's balancing risk and reward. So we have invested around 50 to 60% before the December quarter result. So in the early January or in the maybe the last week of December, so we have invested 50 to 60%, and now we will take revised decision post the December quarter result. Actually the December quarter result is on 16th, maybe. Yes, this is the 16th, today is 14th. Actually that's why I am doing this video, 14th is right now around 9:22, 9:30. So I'm not sure today I can complete it or not. So anyways, so after the result I'll take the revised decision whether to increase investment in AIF or not to stick. Now in advisory service, while we recommend multi-bagger stocks and all, I can recommend the stock only after the December result, the stock price sustain some key technical level and the stock price display positive bias at least for the 1 month. Why? In my personal portfolio, I can take 30, 40, 50% downside risks. Nobody is there to question. In AIF portfolio, if the stock price drops by, or if the AIF portfolio falls by 30, 40%, investors will question, investors will panic. So not that kind of risks I can take. In AIF, we had already clarified to the investors, okay, at any point of time 20-25% drawdown on your overall capital is possible, and this is quite feasible. In advisory service, while we recommend a stock, people don't understand anything. So if they find okay, the stock price is down by 40-50%, they will question, your research is bad, why you are not doing this, that. They will never understand the kind of effort and all the hard works behind any particular stock. So this is why these are the three stands that we take on different portfolio. Now I'll share some key insights and some very important lessons or some very important insights. Now, first key insight is, let's assume we discovered the same stock back in July 2025. Now if you look at this July 2025, okay, so let's, if I just increase this, so this is the July 25. Actually this time the company came up with the result. So let's say we are now at July 2025. So in July 2025, what happened? Promoter open market purchase across January to June. This is one of the big positive. First time in the last 2 years their guidance are reflecting on numbers, as I have mentioned. So this is the turnaround quarter, this June 2025. This is the turnaround quarter. You will find the growth rate was slow. So this is the June quarter, is the company rebound. The company rebound their margin. This is the quarter that they improved their profitability and everything. And you kindly read the July 2025 management conference call. You will find all the positive things. So promoter purchase, positive guidance reflected in numbers. There is a clear indication or commentary that the worst are behind. So whatever the positives we are discussing today, those are fast reflected during July 2025. It was a no-brainer to buy even during that July 2025. Now let's say with the same logic and same research, we purchased at July 2025. We invested at 360 370 range. During July the price was this 350, as you can see, 350 360. This is where the result came, the price moved up. So it is perfectly fine to invest in this 360 370 level. Now after that investment, what happened? Now let's have a look. So from that level, from this July, okay, so let's do a quick from this level to this, as you can see, there's a 30% downfall in the stock price. So considering, as I have mentioned, so if we had invested in July 2025, by the end of December 25, the position would have resulted a 20-25% loss, despite the fact that September 2025 result came in even better with an improved outlook, which validates our investment rationale. So does that mean that whoever invested in July 2025 made a bad decision? Obviously no. It is just that the July 25 investment will take more time to mature. Within May, June 26, I mean once this Q4 result will come, it will be proved whether the thesis is working or not. If it works, then from May, June 26, it might take another 1 to 2 years to unlock its true potential. Unlock its true potential means the multifold return, even if someone invested at July 25. Now here's the interesting thing. Time again and again we communicate, please don't invest with us in AIF, in the 1 to 9 wealth fund, or don't take subscription unless you remain committed for 3 years and follow everything as it is. Let's consider this Onward technology example. It will clarify you a lot. See, as I mentioned, it would have been perfectly fine even if we invested during July 2025. You just go back to July 2025, read the conference call, check the numbers, and tell me a single reason that one should say, okay, that was a bad stock in July 2025. You don't find anything. In fact, that frozen cash thing that came into public later this August or maybe September. So you go back, please go back to July 2025, research and tell me one point, one negative that one shouldn't invest. I can show you 20 positives for every negatives back in July 2025. Now it might take until May, June 2020, sorry, this is May 20, not 25, that is 26, to understand whether the thesis is working or not. So ultimately the point is, whatever the margin expansion and growth happened in the Q1 and Q2, so market is just looking whether this is sustainable or just a one-off event. If in Q3 and in Q4 FY26 again such kind of growth sustained, then I am sure then the market will relook and then the PE might re-rate. So if it won't work, now let's say in December quarter the result came bad, in March quarter also the result was worst, so then it will be clarified, I mean by the end of April or May 2026 when the Q4 result will come. By that time we can have a clear idea whether the thesis is working or not. If it won't work, then we need to exit at whatever loss and then reinvest somewhere else to recover the loss over the next 2 years. And if the thesis works, then over another 1 or 2 year from June 2026 the stock price will unlock its true potential. So again I am repeating, back in July 2025 it was perfectly fine and a brilliant idea to invest in Onward technology. Over the next 1 year things will get proved, like okay, whether the thesis is working or not. If it was not working, then we need to exit at loss and then we need to reinvest in somewhere else to recover the profit over the next 2 years. If it works, then anyways it will take 1 to 2 years to unlock its true potential. This is the reason. And just let's consider the hypothetical scenario video of after so much hard work, so much spending, so much time and all, we invested in AIF, or let's say we recommended the stock in 350, 360 range. Obviously, due to broader market weakness, the fall in small cap index in November, December, there's not enough stock price fall, I mean, on the Nifty Sensex. So the fall is not that much, you can't visualize that fall. But if you look at the broader market, small cap, mid cap, most of the stocks corrected brutally over November, December, and maybe that's also a part reason, and that's why by the December the stock price came down to 270 level, resulting a 20-22% loss. So after looking this loss, as usual, people start commenting, someone else is offering this much percent of return, why your stock is giving a 20% loss? You guys focus more on research, why the price is not moving up, why even after paying for advisory I am at loss? Yes, these things hard. Even earlier, we used to provide the justification, long write-up emails, no, this you need to understand the market, this is the nature of market. But then we realized those justifications providing long reply are just a wastage of time and resource. Instead, we should utilize that time in equity research process. Today we try to avoid replying to whatsoever criticism and all, and one of the another purpose of making this video is maybe in future, if you ask such kind of questions, why the price is not moving, improve your research, we can take the reference of this video. Okay, so kindly understand the reason. So our final suggestion, with same kind of efforts, it's not like that we are working less while the return is negative, or we are working very hard while the return is positive. It's nothing like that. With similar kind of effort, just because of the nature of market, mainly small cap and micro cap stocks, time will come when looking at your portfolio return, looking at the return of our recommended stocks, you will think we have some magic stick in our hand. Similarly, a time will come, remember very carefully, listen very carefully, a time will come while the return will make you doubtful about our capability altogether, and you may push to criticize. Obviously, again I am repeating, we'll waste our time and energy if we react based on investor feedback. Kindly realize there is nothing to repent. Loss on any portfolio or loss on overall portfolio doesn't necessarily mean we are doing something wrong. It's nothing like, okay, we need to accept our mistake and then we need to move forward. No, there's no mistake at all. Profit and loss are the part and parcel of the process. Another point that I wish to emphasize, that our own investment in the market will always remain much higher, probably any of our subscriber, because we have our own investment. While we are a SEBI registered AIF, we need to invest multi crores in our own AIF fund while we are managing. So our own commitment, our own investment will remain much higher than yours. So that's why you are bound to put effort irrespective of the result. So please don't think that loss means we are putting less effort, profit means we are providing huge effort. It's nothing like that. This is the nature of stock market. More so, this is the nature of micro cap and small cap stocks. Sometimes it offers huge returns, sometimes not, with the similar sort of effort. And please don't think whenever return is huge that, oh, we are doing something magic. No. Similarly, when there is loss, we are not putting efforts, nothing like that. So that's why I'll end this video with the same suggestion. Please don't invest with us, or don't take subscription unless you remain committed for 3 years and follow everything as it is. The example of Onward Technology was very clear. If something goes wrong for Onward Technology, there was nothing wrong even if we recommended the stock or invest in July 2025. So from July 2025, another 1 year it may took to prove whether the thesis is working or not. If this thesis is not working, we need to exit at loss, and if we exit at loss, then we need another 2 years of time to recover the loss from some different investment. Or if we realize, okay, now the thesis is working, the stock price is temporarily in a downfall, then we may stick with the same stock to recover over the next 1 to 2 years. And if the thesis is working, the stock price also gradually moves up, then everything is fine. Even then also we need to hold for maybe another 1 or 2 years to get outsized return. And on those another 1 or 2 years, let's say by the end of 26, some overall bull market returns, or by early 2027 the overall market remains enters into the bull zone, then automatically what will happen, this 15, 16, whatever the PE today you can see, this can immediately jump to 25, 30 kind of, or maybe more than that, and then automatically the price will re-rate. So we'll end the video. I hope you got a lot of clarity on our investment process, how we select stock, how we research, how from a vast universe we refine and shortlist stocks. So we'll again end the video with the simple request, kindly don't invest or don't subscribe unless you remain committed for at least 3 years and follow everything as it is. So thanks a lot for listening over a long time. Maybe it's a 1 hour long video. So thank you once again for listening, and happy investing as always.